What's up guys, welcome back to my channel. Yes, we are discussing terminology in this video, most importantly the top 10 terms you need to know before investing, so let's get straight into it. Yes, I am doing a giveaway over my Instagram, so go check that out. You can be in with a chance to win €100 to get your portfolio started, so go check that out. Alright guys, term number 1, volume. So what is volume? So volume refers to the amount of shares being bought and sold on a given day in a particular stock. It can be found as a subchart below the main chart. I would use the volume chart and an RSI chart under my main chart when I'm investing. It shows the popularity of a stock. For argument's sake, NEO. So NEO has an average volume per day of about 300 million. So that is pretty high and it's pretty popular right now. This can be tied in with news articles about particular stocks. So if a news article or quarterly earnings comes out, usually popularity in that stock rises and the volume rises as well. So if you go down to Webull, there is a section saying most active in regards to volume, so you can find out which stocks are popular and which stocks are not popular in a given week. So it is important to know this term. Term number 2, volatility. Now you always hear me in previous videos about the stock market being volatile and things like this. It refers to the rapid buying and selling of shares. It's usually brought on by fear. So if there's fear in the market, there's a lot of buying and selling, a lot of quick rapid trades, a lot of ups and downs. So the market could be up in 1 hour and the next hour it's dropped. So it is pretty dangerous to be trading in these times because you can lose a lot of money. So that is a good term to know. Term number 3, an ETF. What is an ETF? So an ETF is exchange traded funds. So exchange traded funds are a combination of stock put into one graph. So they're usually in the same sector, like an oil sector, tech sector, or real estate sector. Instead of putting your money in one oil company, it will spread your money out evenly over multiple oil companies. It reduces the risk of you losing money and it diversifies your portfolio. Moving on to term number 4, which is the expense ratio. So an expense ratio is tied in with ETFs. Yes, when you invest in an ETF, it does cost you a little bit of money. So it's usually fees in relation to management fees and administration fees of that ETF. It's usually a percentage of your assets, 0.5% to 1% of your total assets. So it is good to do your research before you buy an ETF to figure out what is the expense ratio of that ETF. I know Vanguard does a very low cost expense ratio in relation to their ETFs, so go and check out them if you're into ETFs. Term number 5, market sentiment. So market sentiment is like the opposite of market volatility. It's the confidence in the market. If there's an earnings report coming out about NEO and people are confident that it's going to be a good earnings report, the market sentiment will be high. Moving on to term number 6, so CEO and also CFO. So most of you already know the CEO, Chief Executive Officer, the big boss of a company. You can usually be a CEO and founder like Mark Zuckerberg of Facebook, but you can also have CFOs. Now CFOs are Chief Financial Officers of that company. So they are the big boss that runs the numbers. We hear of a CFO more than a CEO in the stock market. As you know, the companies we invest in are public limited company. Their financials have to be public. So CFOs, yes, they're the big boss of the financial side of the company. You'd often hear them around earnings dates talking about their estimates for the quarterly earnings and things like that. So it's good to know the term CFO. Term number 7, a share buyback. So what is a share buyback? A share buyback is when a company purchases its own shares on the stock market. It reduces the amount of shares outstanding on the stock market and it increases the attractiveness of the company by reducing the price to earnings ratio. It basically makes the company look more profitable on paper, therefore increasing the attractiveness for new investors to invest in that company. Term number 8, day trade. Now this term is very important as it goes on to the next term. A day trade is to buy and sell a stock on one given day. So basically if you buy in the morning and sell in the evening, that is classed as one day trade. So take that in consideration. A day trade is buying and selling a stock on the same day. That's it. So moving on to term number 9, pattern day trading rule. Now you have to be careful with the pattern day trading rule because you can get banned up to 90 days. So what is the pattern day trading rule? If you've under $25,000 in your trading account, you can be subjected to the pattern day trading rule. So when you buy shares in a company, you're sending your money to that company to help them grow. And if you sell them, you're messing up their accounts. And with small investors, they're buying and selling rapidly, it's just messing up their accounts. So they put a cap on it, 25,000. If you've over 25,000, you can buy and sell whatever, whenever you want, because it's a large amount of money coming in and out. So they set up this pattern day trading rule that if you're under $25,000 and you day trade more than 3 days in a working week, your account can be banned, basically for pissing them off. Yes, be careful of that rule, because I've seen people that have gotten banned messaging me, what can I do? You can't do anything, you know. You can't do anything about it. You have to wait 90 days. 3 months, that is a long time to wait. So definitely one to consider. The final term, dividends. So what is dividends? So dividends is paid out quarterly from the companies to the investors as a thank you. So dividends is a percentage of their stock price. I'll give you an example. You have 100 shares of Apple. Now Apple's dividend per share is 82 cents. Now every year you will get 82 cents per share, but you have 100 shares. So every year you will get $82 if you have 100 shares as a thank you for investing in Apple. Now this is paid out quarterly, so you divide it by 4. So you get paid $20.50 every quarter if you have 100 shares of Apple in the form of dividends. I'm not a dividend investor myself, but if you actually set this up properly and you buy companies that pay dividends, you could set this up to get paid every month by different companies. So it is pretty cool. It is a long-term strategy, and maybe I should actually start doing it. So yeah guys, that's it for this week's video. I know it was pretty relaxed, happy days, but yes, this channel is growing immensely in the last few weeks, so it is good to see that. I will mention our Facebook discussion group, Revolut Trading Our Journey. It is pretty fun down there. There's a lot of crack over there. So as always, I hope you enjoyed it, and I will see you guys in the next one.